March 8th, 2023. Much maligned Silvergate Bank, which grew rapidly by lending money to cryptocurrency customers, announced it would be closing its doors after sustaining massive losses from last year's crypto crash. Some people saw it coming, but no one could have predicted what would happen next. Hello and welcome back to Lean on Success, where process improvement is self-improvement. My name is Ben. I'm a Lean Six Sigma Master Black Belt, and today we're going to talk about the recent bank crashes and whether your bank could be next. But before we get into it, make sure you hit that like button and subscribe to this channel for more content. Now, in previous videos, we have detailed the failures of recent banks that have occurred. And that March 8th date, I want you to keep at the front of your mind because we're going to be using that as a milestone to track the performance of stocks over certain banks. But right now, I want to dig into First Republic Bank and figure out what happened with this recent bank collapse. Earlier this week, we got news that First Republic Bank was closing. It crashed. It failed. And it was sold to JP Morgan in what AP referred to as a fire sale. Now, to understand what happened with First Republic Bank, we first need to talk about what LDR is, because that played a huge part in what caused First Republic to fail. LDR refers to the loan deposit ratio. This describes the volume of customer deposits that were held by the bank, and it's expressed as a percentage of loans that are made to customers. Now, generally, an LDR above 100% suggests a high-risk environment for that particular bank. Now, in a previous video, we talked about something called loan to value, or LTV, which is a good way to express how risky a particular customer is in terms of borrowing or getting a mortgage for a house. LDR, or loan to deposit ratio, is a similar metric that we can use for banks in terms of how risky they are. The way to think about it is, if a bank takes in deposits, we want to understand what percentage of the money they're taking in that is being loaned out to other customers. Now, part of what we've seen in the recent months is that deposits have plummeted due to customers losing confidence in the bank's ability to stay solvent. We saw this with Silicon Valley Bank. Now, if you refer to the video that I did with Scott Barber, our CPA that works for the government, we talked in more detail about what happened with that particular failure. In light of that, because deposits have dropped so significantly, a lot of banks have had to decrease the amount of loans that they've given out so that they can keep their loan to deposit ratio in a positive light. Now let's dig into the numbers as it relates to First Republic Bank. As of January 1st of this year, their loans were $166 billion. That's how much money they lent out to customers across mortgages and other loans that they did. Their deposits were $176 billion. What that basically means is that 94% of the money that they held in deposits was being loaned out to other customers. Now, by industry standards, this is extremely risky for that bank. Here is the stock performance of First Republic Bank over the last 2 months or so. The time, First Republic was trading at $115. As you see, just a few days after Silvergate announced their closing, the stock plummeted dramatically to $31. About a week later, the stock plummeted further and was trading at just $12. And as of May 1st, it continued its decline to just $3 a share. This is a precipitous fall from the previous amount that it was trading at just on March 8th. Now, later in this video, we're going to be looking at the stock performance of several other banks, but I think it's important that you get a proper perspective on what's happening in the overall market. What you're going to find is a common theme where there was a significant drop around March 8th when Silvergate announced that it was closing. It brought the whole market down. But what you're going to see is that some banks are recovering faster than others. And it's important to contrast that against what's been happening in the overall stock market since March 8th. Here is a chart of the Dow Jones Industrial Average, which is basically the performance of the stock market since March 8th. As you can see, it was trading at around 32,800 as of March 8th when Silvergate announced its liquidation. 4 days later, it was trading a little bit lower at just under 32,000. But as you can see, by March 20th, it had already recovered to just over 32,000. And as of March 1st, it actually grew to 34,000. That's an important contrast. We see that First Republic did a precipitous fall on March 8th and never recovered. In fact, it kept going down. However, we see that the overall stock market did dip initially, but then made a recovery going into May. Now, I'm sure that a lot of you have been really concerned by the recent bank failures that have occurred. We've had 4 major banks that failed since March 8th when Silvergate announced their liquidation. So what I wanted to do is to evaluate our banking system to determine whether there are future banks that are set to fall. So I want to give you a little bit of background on how I did my analysis. Firstly, I looked at the 50 largest banks in the United States according to how many assets they held. Now, what I did was I looked up their loan to deposit ratio against their stock performance. In other words, whether their stock gained or lost ground after March 8th to today, and I plotted those on a scatter plot. Now, the grid is going to show the relative amount of risk that I perceive based on these 2 particular variables. Now, there's a couple of things that I want to go over before we get into the data. The first is I am not suggesting that any of the banks on this list are set to fail. There are a lot of factors to go into whether a bank chooses to close or not. The second thing is, those of you who have been watching my channel for a while, you understand I'm not trying to incite panic. In fact, just the opposite. I want to provide information that allows you to make educated decisions about how you're going to manage your money and your finances and make financial decisions in the future. So I'm not trying to tell everybody to pull all your money out of the bank and run for the hills. I want to provide information that's going to allow you to make educated decisions about how you're going to make financial decisions in the future. Here is a grid of the 50 largest banks in the United States where I have looked at their stock performance, which is represented by the vertical or y-axis, versus their loan to deposit ratio, which is on the x-axis. The green sector represents what I believe to be the safer banks. These are the banks that are not as in much trouble. Their stock performance has been relatively mild or even experienced gains since March 8th, and their loan to deposit ratio is below what the industry standard is. The banks that are in yellow, I think, are kind of in the middle, where their loan to deposit ratio tends to represent more what the average is, and their stock performance has suffered. Most importantly, the banks that are in red are the ones that I think are at the most risk. Their loan to deposit ratio is problematic, and they've had a stock performance where their stock has fallen by 30% or more since March 8th. Now, when I started compiling this data on Tuesday, which would be May 2nd, I was going to point out that one of the banks we need to really watch carefully is Pacific Western Bank, because their loan to deposit ratio was extremely high, very problematic, and their stock performance had gone down more than 60% as of May 2nd. Now, I don't mean to say that I'm some type of wizard or prophet, but breaking news just came in. Pacific Northwest is in trouble. It's starting to consider liquidation based on all of the factors that we just talked about. In fact, when you look at their stock performance, you see that on March 8th, they were trading at $26, but they had a precipitous fall after that, and it continues to go further and further down. Let's look at some numbers for Pacific West. Their loan to deposit ratio is 132%. That means they're loaning out significantly more money than their deposits. and their stock is down 66% as of May 3rd and continues to fall. Now imagine my surprise when Tuesday night I'm starting to compile this data and preparing my script for talking about Pacific West potentially being in trouble, only to wake up to an article on Wednesday, May 3rd, that Pacific West is in trouble and considering closure. This tells me that there's some credence to looking at these particular metrics and trying to understand what banks might be next in terms of the next domino to fall. So what I want to do is review some banks that I think are next on the list in terms of being troubled and potentially going to close. In addition to Pacific West, the next bank we need to watch is US Bank. Their loan to deposit ratio is 82%, which is slightly higher than the average for a bank their size, and their stock is down 27%. As you look at the run chart of their stock performance, it does not resemble any type of recovery that the overall Dow Jones showed. But what's especially problematic is, even though their numbers and their performance isn't as bad as some of the other banks on this list, US Bank is the 5th largest bank in the United States. So the fact that we see all these numbers now and their size gives me some pause to think that we need to watch this bank because they may be in serious trouble. The next bank to watch is Comerica. Now they've got a loan to deposit ratio of 85% and their stock is down 37%. When you look at the shape of their run chart of their stock performance, it looks very similar. There is no indication of recovery associated with this bank. This is a major bank that we need to watch for potential failure. Next on the list is Western Alliance Bank. Now their numbers look very similar to Pacific. Their loan to deposit is 138%, which means they're loaning out a lot more than what their deposits are. Their stock is down nearly 60% since the Silvergate collapse. A couple of other banks I want to mention that I think are in serious trouble are Valley National Bank and Bank United. Both of these banks have loans that exceed their deposits, and their stock is down more than 30%. Now, I want you to understand me very clearly. If you have less than $250,000 deposited in an account in one of these banks, which is most of my audience, you have no reason to panic. You have no reason to pull all of your money out. Even if your bank fails, there are multiple things in place to make sure that your money is safe. And I want to point one of those out to you right now. This is a direct quote from the FDIC website. What it explains is, if a bank fails and there are insured deposits, in other words, any deposit accounts that have less than $250,000 in them, the FDIC will pay the insurance out within a few days after the bank closure. The FDIC will make the depositors whole within a few days after any potential bank closure. They'll do that either by providing you with a new account with the same amount of money you had in it with the new bank, or by sending you a check in the amount of the deposits that you held in the bank that closed. These transactions will. Now, in addition to the FDIC guidelines and what their insurance guarantees, a couple of weeks ago, I released a video with Sarah Kaplan entitled "We Don't Talk About Crypto." And in that, we shared 7 do's and don'ts for personal finance. We want to make sure that you don't panic in this situation, but that you have all of the tools and the information you need to secure your personal finances, even in the midst of recession and bank closures. Now, just to be sure that you know that I'm putting my money where my mouth is and I'm practicing what I preach, listen, I'm not rich, okay? I don't have $250,000 in cash in a particular bank. The amount of my savings is way less than that. But I want to share with you what I'm personally doing from a banking standpoint. Now, I have a relationship with my local credit union because for years they've been able to service us on particular auto loans, and we've been able to get good deals on cars that we financed over the last 10 years or so. So I do have some accounts open through a local credit union for that purpose. Additionally, I have opened a checking account and a savings account at a major bank, one of the big banks. Part of the reason is when we travel out of town, we want to make sure that we have ATM access and we can get our money for free from major banks. So we want to be able to have the flexibility of going to a major bank's ATM and being able to withdraw cash when we need it. So I'm not pulling my money out of the bank. I have high yield savings accounts. I have regular checking accounts. I have regular savings accounts. I am continuing to do regular business with a local credit union as well as major banks because I have confidence in our financial system. So rest assured that if I'm telling you not to pull your money out, just know I'm doing the same thing. I'm continuing to keep my money in safe deposits because I know that the FDIC is going to insure every dollar I have in my accounts. The last thing I want to say is it's important for us to remember that financial markets go through cycles. A lot of you are old enough to remember the 2008 Great Recession, all kinds of bank closures and panic in the streets and so forth. Now, some of you are also old enough to remember the savings and loan crisis from the late 80s and early 90s, where we went into a recession. They call it the Gulf War recession. We went through a down period there. In between that, we had the dot-com bubble, where there was a recession and a whole lot of panic in the streets there. Some of you are even old enough to remember the oil embargo from the 70s and the double-digit inflation that we experienced in the late 70s and going into the early 80s. The point is, the financial markets go through cycles. There are ups and there are downs, just like in a roller coaster. The only people that get hurt on the roller coaster are the people who try to get off in the middle. So it's important for you to keep your money in the bank. This is not the time for you to panic. It's not the time for you to get a whole bunch of gold bars and keep them in a safe in your house. You need to ride out the storm. Again, the video We Don't Talk About Crypto, that points out and that lays out specific things that you can do to make sure that your finances are secure. Again, not the time to panic. If your particular bank is failing, your money is going to be insured up to $250,000. Did you find any of this interesting? Did I get something terribly wrong? Did I completely bore you to death? Let me know down in the comments and share this video with your friends. Until next time.